will you put his on there too? Thank you. So thanks everyone for being here. It's my pleasure to introduce the moderator for this panel. So those in this room know how exceedingly rare it is to find someone who has training in both law and economics, and who researches and writes on finance, financial regulation, payments, and history, which is all obviously interrelated things, but things that rarely come in one person. Carolyn is one of the exceptions. She's a senior lecturer at the University of West England, Bristol. She holds a PhD in economics from UCLA, and a JD from the University of Southern California Gould School of Law, is that how you say it? In addition to analyzing financial markets and financial regulation at her Synthetic Assets blog, she's written numerous influential articles. They're all on SSRN, you should all read them if you haven't. And she's also very thankfully agreed to moderate this panel for us today. So thanks, Carolyn, and take it away.
Thank you very much. I was delighted to be able to moderate a panel on payment systems, which is one of my favorite topics. And we have experts here on the payment system, in law, in history, in economics. So I think it's going to be a really good session where we're going to be able to talk about a lot of different aspects of the payment system. Our first presenter is going to be Awrey. He's a professor at Carrillo Law School. He's got a background advising the Treasury, the BIS, the UK Treasury, ESMA in Europe, and he's the author not just of a textbook on financial regulation, but also important articles on regulation, including bad money, and a related forthcoming book titled Gresham's New Law. So, looking forward to it.
Thank you very much for the introduction. I will now sneak in my chair. So it's great to be here today. This is about the most number of people that have shown up on a payments panel on the afternoon of day 3 of the conference in my entire life. And I apologize for looking over my shoulder, but I have to remember what it is that I wanted to say. 27-year-old Dan could have seen that screen. 47-year-old Dan sees a blurry Canadian man. This is very, very early stage joint work with Josh Macy, Chicago, and Jeff Shang at Michigan. And our goal was sort of to take the idea seriously that payment networks are actually networks. Oh, it's going to happen. With me, yeah. All right. That's okay. I can do this Price is Right style. Our idea was to take the observation that I think most people would agree with, that payment systems are infrastructural in their nature, primarily because they're networks and you got to build them. And once you build them, you want people to use them. But you've got sort of a series of problems that you've got to solve. Decisions that you have to make as builders of financial market infrastructure. 3 big ones are how to make your network stable, how to make sure that people can use it, and that if you rely on intermediaries, that they can provide the intermediation, the conduits between other nodes in the network. And lastly, you got to find some way to finance the thing. And not just at the beginning, but roads break down, electric power lines degrade, the internet gets dumber every day, and so you've also got to think about the ongoing maintenance, upkeep, how to incorporate new technology when it becomes available, meaning that at every stage in the life of your network, of your infrastructure, you have to think about how you're going to incentivize people to continue to develop new products and services, how you're going to maintain the existing infrastructure, and how you're going to change it to hopefully improve it over time. When you're building financial networks, these are the big decisions that you think about. The first thing to note there is that while those 3 things are important, they are not typically what we think of as the policy objectives associated with building good payment systems. We think about things like speed and access for consumers, we think about financial inclusion and fairness, and we think about things like cost. All of these things intersect with the reasons that we build, or the decisions that we can make when we build infrastructure, but none of them are the same thing. And one of the key things of our project is that building the infrastructure and ensuring that it achieves its public policy objectives need to be understood as two different things. And our goal in this paper is to understand how to bring them together effectively in one place. In that process, it's also to help us better understand the trade-offs that we often face when it comes to trying to do these three things at the same time, ensure stability, access, and investment. So we use a trilemma framework. I'll say right now, I have a love-hate relationship with trilemmas. They often get used as, well, you can have two of these things, but you can't have the third. And often that's a result of the models that underpin these trilemmas. I'm a bigger fan of the softer trilemma model, which says, you know what, if you want to have these two things, you're going to have some difficult choices when it comes to the design of that third thing. Somewhere, something's got to give, and what we're trying to do is understand what gives in the context of each of those decisions. So it's trilemma-ish. We still think it's useful because there are three things that are important in building infrastructure, but our goal isn't really to parameterize fully these trade-offs, but to help understand directionally where they take us. So in terms of stability, when we're talking about payment systems, we are talking about, as we are with all networks, the ability of those systems to continue to do the things and deliver the stuff that we need delivered under conditions of stress. In payment networks, as I'll talk about more in a moment, that typically involves things like prudential regulation to ensure the integrity of the system. It also involves things like anti-money laundering and terrorist financing laws. Then we have access, and here is one of our cute intellectual sleight of hands that allow us to make this a trilemma. Access really for us is a two-part question. One, in an intermediated system, who are the intermediaries that we let in? Two, that's the means, right? We use banks as a means to make payments. But the end is that somebody, a person, a business, a government, can use these networks effectively as the end user, and that's the end. Then we have the question of investment. Investment comes in all sorts of flavors and colors, but for our purposes, we're really interested in when private investment is likely to be forthcoming, and when some form of public investment may be necessary to build, maintain, and upgrade that sort of infrastructure. And again, the whole framework is really just about understanding if I've got two of these things, or how should we think about the design of the third, and are there things that we're going to have to sacrifice along the way? The paper, once it exists, we've got one component of it at the moment that we've shared with you guys. We'll look at 3 case studies. One, the one I'm going to focus on today, is the domestic US payment system. The other 2 are the global correspondent banking and international payment system, and the emerging, evolving stablecoin ecosystem, both domestically and internationally. All right, so let's take a look at the domestic US payment system for a moment, where the story here is really one of stability plus access equals private underinvestment. The stability comes from prudential regulation and supervision, as I'll talk about in a moment, that is necessitated, often framed as being a response to all of the financial safety net apparatus that we use to protect the banking system. But to contain that subsidy, we also have strict restrictions on both who gets to become a bank, maybe for some not strict enough, but they're there and they're pretty expensive. Combined with restrictions on access to basic financial market infrastructure. And the basic story then is if I take something really expensive to comply with, like regulation, I add in legal constraints on who can actually be part of the network and who gets to make decisions about how to build out the network, then what I'm going to be left with is a fairly uncompetitive group of incumbents, all of whom, if given the opportunity, will find ways to extract rents out of the payment system. And so let me drill down on that in a little bit of detail so that we can all take a look at this. I know you all showed up to the payments panel, but I don't want to presume too much institutional knowledge. The bit we're most likely to know something about is the stability component of this, where we have the lender of last resort arrangements that we've been talking about for the last couple of days. We have deposit insurance, we have bank resolution regimes, all of which are designed to help banks as an institution survive under conditions of stress where other businesses don't get to survive, right? Other businesses go bankrupt. Banks are treated differently in both financial and economic distress. Against that backdrop, then, effectively to resolve the resulting moral hazard problem, we have things like bank regulation and supervision, so capital liquidity requirements, all the things that the OCC, the FDIC, state banking regulators do to ensure the safety and soundness of banks. And it's expensive. The average for the big 25 banks is about $1 billion a year on regulatory compliance. And even for the smallest banks in the United States, compliance costs as a percentage of net interest income are extremely high. This is not an easy thing to be a part of, although, as you'll see in a moment, it can still be very lucrative for you. Having given banks the benefit of financial safety nets and having extracted from banks the regulatory compliance necessary to benefit from that safety net, the Federal Reserve Act also then restricts access to the payment system, who can hook up to the networks, who can be a licensed node in each of these networks. This starts with Section 13 of the Federal Reserve Act, which says that banks and a few other public actors, a few other things that we don't call banks in the United States, because that would be way too easy, but effectively our banks get to hook up, everybody else doesn't. Add on to that the fact that having a direct connection to the Fed via the master account mechanism is an operational and legal precondition to signing up to CHIPS or ACH or RTP, certainly FedWire. All of the major clearinghouses means that effectively it's banks all the way down throughout this system. Banks are where we go to make payments, banks are the people that process payments, banks are the people that own the infrastructure that clear payments, and banks are the people or the businesses that are at the heart of the ultimate settlement mechanism in terms of Federal Reserve accounts. To most of us, this seems pretty normal, right? Certainly in the United States, nobody alive today knows any difference. But if you spend your life in payments, one of the things you do kind of notice is that the United States has sort of fallen behind internationally on payment infrastructure, and particularly the adoption of new technological sort of advances that have sped up the speed of payments, lowered the amount of time that it takes to detect fraud in payments, and various other sort of conveniences that we enjoy elsewhere. Well, I guess they enjoy elsewhere now. Yeah, I live in the US. You guys looking here all smug with your tap and go.
FCC payments.
Yeah, exactly. And part of the reason for that, part of the story here is really the incentive structure of giving a whole bunch of incumbents, and specifically large incumbents, the ability to really reside unchallenged at the heart of this infrastructure through many technological cycles. And you may say to yourself, but Dan, there's 4,500 banks, 5,000 credit unions in the United States. What do you mean this is like an oligopolistic system? The big four banks process the majority of payments. Once you get into the top 15 to 25 banks, you are talking about most payments clearing through the final settlement mechanism, FedWire, and master account. It's a fragmented system as a banking system. It's a concentrated system as a payment system. And the next question is, well, what are you talking about? Are you a conspiracy theorist or a plumber? And I like to think of myself as a plumber instead of a conspiracy theorist, so let me go into this a little bit more detail. There's lots of examples of how banks can use this privileged position at the heart of this infrastructure to generate income that wouldn't exist if they adopted the latest technology. Aaron has done great work shining light on overdraft fees and how the payment system feeds into that. The one that I'm going to focus on is generating what's known as float revenue. Around the room, none of you were alive when old school float revenue was at its height in the early 1980s. This was a period characterized by high interest rates, which meant that if I, as a bank, receive a payment from a payor and then kind of slow walk the process via which it ultimately gets credited to the payee's account, I can earn myself some pretty sweet interest. And this is all we're talking about when we talk about old school float revenue generation. This was particularly pernicious in the United States because the United States, for reasons that I will lament to my grave, loves checks, still loves checks. And I'll talk a minute about why it's preposterous that it still loves checks in a moment. But in a system where you've got paper checks that then has to go through a costly process of physically delivering them across the country, both in order to deliver them to the original payee, who then has to deliver it to their bank, the silliness of that in a country with the geography of the United States ultimately is what gave rise to float opportunities. These opportunities were huge in the 1980s. Interestingly, the time it took to process payments in the early 1980s, between 1979 and 1982, those of you who know your interest rates, you'll know that not a low interest rate period, actually increased. Payments got slower as interest rates went up in the late 70s and early 80s. People got really mad at this. Senator Chris Dodd ultimately got super mad at this, leading to a series of hearings in the early 1980s that led to something called the Expedited Funds Availability Act, which ultimately set maximum hold periods for how long you could hang on to a check. But those hold periods still existed, and float revenue was still possible. What really killed float ultimately was the low interest rate environment that we had until very recently, where the opportunity costs of hanging on to checks for large periods just went up. And so float discussion went away for most of the last 20 years, basically, and then boom, it came back in a different form. On the last panel, there was some discussion of the ample reserves regime that we're in at the moment, and this has created some new opportunities to generate float revenue. So in the scarce reserves regime, what you would expect to find, and in fact empirically did find, was that the speed with which an outbound payment was made by a bank was very related to the incoming payments. And that's because it was a just-in-time flow, right? You get reserves in, and that enables you to make outbound payments. And this was seen in empirical data in Fedwire, where everybody waited to the end of the day to make payments on Fedwire, because you got all the payments in, and that meant you're good to go. This led to something called a payment reaction function, which you can measure, which is just the relationship between an outbound payment and an inbound payment. Does the timing of my outbound payment is there a relationship between the timing of the outbound payment and a new inbound payment coming in? In an ample reserves regime, you should expect this relationship to disappear, right? You're sitting on a warehouse of things that you can use to make payments. And yet there was a paper that came out after, I may say, that the Federal Reserve Board denied that float revenue still existed, which actually stopped this paper in its tracks the first time around. Lo and behold, a month later, Duffy comes out and saves my career, not for the first time, and says, look, this payment reaction function is the same. They're still operating like it's a scarce reserves regime, which then raises the question, what are they doing with all those reserves? And the answer, or at least part of the answer, is twofold. One, over this exact same period, and this is the chart on the bottom right here, the big four banks, the big banks that are most active in payments, have also gone from a long-term position as net borrowers in the repo market to net lenders. And they're effectively, and I wish I had this for the last couple of years, they effectively did what I would have done when I was working in markets, is that I'm triangulating the interest on excess reserves that the Fed pays and the interest that's payable in the GCF and other repo markets. And I'm like, that just became attractive. And all of a sudden they shift into that. And what we're calling this, not us, but sort of the people that look at this now, are reserve draining strategies, where all of a sudden we are able, both the clearing banks are able to do this directly, moving into a net lending position in the repo market. But also, because, and I gotta give a tip of the cap to Saleh here, we've still never solved the problem with Section 23A and 24A of the Federal Reserve Act, which means that these banks are also lending to the broker-dealer affiliates in order to, again, invest in repo, but also enter into FX swaps. And these reserve assets are becoming the basis of that. All of which to say, both old school float management and new school float management just demonstrate, they change over time. But if I can generate revenue simply by virtue of the fact there's a latency in the payment system and small pennies on billions of dollars add up, I'm not going to be totally incentivized to do things like invest heavily in faster payments. And we can talk in the Q&A, because I imagine at least one person in the room is thinking, well, what about Fed now? What about the Check 21 Act? And the story that I would tell in detail in Q&A, if anybody asks it, is one where the banks have done very well at maintaining their optionality for when a fast payment is made. To take FedNow as the example, FedNow has no consumer interface. One isn't required. The banks get to decide when a fast payment is made. Fast payments in, great. Fast payments out, maybe I'd like to hang on to that money for an extra day and generate some interest income. And that's how both the Check 21 Act in 2004 and straight through to RTP and now FedNow are designed, is that they speed up payments at one end of the spectrum, but don't necessarily speed up payments at the other end. And that's consistent with this idea that the design of this system has been sort of hijacked by a set of special interests that aren't necessarily consistent with the interests of the general users of the payment system. I'm going to finish up real quickly here, simply to say what are the policy implications of this. First of all, and I think I'm required by contract to say this at this point, none of the problems in payments are technological. The whole idea that crypto is going to come along and revolutionize payments is hokum. I've been doing this since, I've been in technology and payments since 1998. The biggest thing to come along was the development of a web-based API in 2000. Everything I want to do to the payment system to make it work, I can do with technology from 2000. We've gotten better at that technology in 20 years, don't get me wrong, but I don't need any new whiz-bang technology. I need the ability of my bank to talk to other players in the economy and to confirm information about my identity and whether I have funds in my account. And web-based APIs enable me to do that already. This isn't a technological problem. It's a problem of political will and coordination. It's infrastructure, and it's infrastructure that crosses jurisdictional lines. It's infrastructure that in its truest form should cross regulatory lines if we were to allow institutions other than banks to actually process payments in the United States, which is what a lot of other countries are doing. And so in that regard, one of the things that we ultimately hope to do in the paper is look to places like Brazil and India and China, where they've actually taken this lesson on board and worked with the public sector and private sector, developing technological solutions, use their leverage as the regulators and overseers and occasional bailer-outers of these financial institutions to say, look, part of your charter is working with us to develop better infrastructure. And that's what we want to kind of look at. In the United States, then, part of that as well is then looking at existing laws that get in the way of this type of public-private sector partnership and coordination that we're interested in. The bête noire of this is a provision 12 U.S.C. 248A, which, if you read it, kind of sounds like it's designed to make sure that when the Fed provides payment services to banks, that it does it in a way that's competitively neutral. The long-standing position of the banking industry about what that provision says is basically that the Fed needs to stay the hell out of payments. This has been made clear in a series of threatened lawsuits over the last several years by the Bank Policy Institute that basically say the Fed shouldn't be competing in payments, and if it does, it has to directly compensate the banks that lose payments for lost profits. And it's just not apparent on the face that that's true. More importantly, this provision was inserted as part of the Monetary Control Act of 1980, the whole purpose of which was to create a more competitive payment system. And so part of our project, in addition to laying out over the longer term what we need to be doing, sort of using other countries as an inspiration, is looking at the existing legal barriers in the United States like this, that would have to be amended or removed in order to make good on that promise. So I will stop there. Thank you very much.
Okay, so up next we have Sean Vanatta, and Sean Vanatta is a lecturer at the University of Glasgow, and actual lecturer in economic and social history at the University of Glasgow, and a senior fellow at the Wharton Initiative for Financial Policy and Regulation. His research examines the transformation of U.S. finance and financial policy, and he's got two books, one with Peter Conti Brown on the history of bank supervision, and another coming out on the bank credit card industry, as well as a bunch of articles published in like Business History Review and Capitalism.
want to say that if we make it through this panel, Dan, without talking about credit cards, I'm going to be sad. So, can we flag that for future discussion?
Sorry, I skipped your slide.
No, it's all right. So I'm using these now.
Yeah, I think the clicker should work too.
Okay, I'll get my spaceship set up here. Cool. All right, so good afternoon. Yeah, I'm Sean Vanatta. I'm really excited to share, like, even to call this a paper is a bit silly, so to share some initial ideas that I'm developing with Jeff Zhang. So the attentive among you will have noticed that he's also a co-author on Dan's paper. And so, I'm really just interested in feedback, ideas, things that we need to read, initial reactions. To do that, I'd like to kind of just jump right into the overall thesis. So first, right, we're concerned with money and with payments, which we see as distinct things. Second, we think of money, so the constitutive unit, capitalist market societies, as existing on a spectrum of sovereignness, so that some forms of money are more sovereign than others. So coins are more sovereign than insured bank deposits, which are in turn more sovereign than money market funds or electronic tokens. And by sovereignness here we mean provided for or guaranteed in some way by the government, particularly here the US government. So our cases draw on US history, but we're certainly interested to think how or whether this thesis can travel. So again, the idea is that money exists on a spectrum of sovereignness. Payments, we argue, likewise operate on a spectrum of sovereignness. So Federal Reserve check clearing is more sovereign than TCH payments, which perhaps more sovereign still than credit card payments or Venmo. And so governments tend to be very concerned about making and keeping money sovereign, or at least more sovereign. But even as they keep money sovereign, governments tend to be more willing to let payments remain less sovereign or private. And so the question the paper is interested in is why this incongruity exists between public money and private payments. And we're just sort of trying to think, how should we think about this? And is there anything to worry about in this mix of public and private? And so the paper, our aim is to develop 4 historical case studies, which I'll come to in a moment. But overall, what the cases show is that over time, in normal times, sovereignness tends to erode. So private actors innovate to mimic the moneyness of money, and they innovate to move money more efficiently on the payment side. And so in normal times, both money and payments tend to become less sovereign in the aggregate. But in moments of crisis, governments tend to reassert sovereignness, focusing more often on money, but usually on both money and payments when crisis comes. Have I moved at all?
Yeah.
Oh, is it?
I have really good slides. This is killing me. What are we doing here? Okay, so sovereignness. Yeah, see here. More sovereignness. Okay, so I think this is where we want to be. Okay, so you can visualize this idea, right, through a rough sketch of money payments in the contemporary United States. So on both sides, we can see recent, and by recent, I mean last 40 or 50 years, monetary and payments innovation that are clustered at the bottom of the table. So for money, we have money market funds, repos, stable coins. On the payment side, we have clearinghouse payments, credit cards, P2P, digital payments. And so in this sense, we can see how in normal times, both money and payments see the sovereignness erode. We can also see how in moments of crisis, less sovereign money is granted sovereignness. So the obvious recent example is the unilateral guarantee of Silicon Valley Bank's uninsured depositors, an action which made less sovereign uninsured deposits effectively sovereign. And we can look back to the recent crises to see this as a kind of typical response, the Fed's backstopping the various sort of money-like instruments in the economy springs to mind. And I was really struck by one of the last panels this question of like state of exception versus permanence in this case. It's kind of a question of when does sovereignness, sort of this effective sovereignness, become permanent. So in any case, that's the kind of thesis, right? So money and payments exist on a spectrum of sovereignness. Money tends to be more sovereign than payments. In normal times, both money and payments drift from public to private. And in moments of crisis, governments reassert sovereignty, often with a greater focus on money than on payments. And so our aim is to kind of develop this thesis through a set of historical case studies. So first we'll focus on major moments of monetary reform, so the US Civil War and the founding of the Federal Reserve, when both money and payments became more sovereign. Then we'll look at some more recent moments of erosion, specifically the rise of private retail payment networks, the credit card networks, Visa and MasterCard, and then the Depository Institution Deregulation and Monetary Control Act that Dan mentioned, which effectively require the Fed to charge market rates for its payment services, inviting private payments competition. And so I can't go into all four cases. We haven't written all four cases yet, so I'll just focus on the first, which focuses on the Civil War. So here it probably makes sense to start with Andrew Jackson. So Andrew Jackson was, of course, president of the United States from 1829 to 1837, and he stands in as a kind of as a figurehead for a mode of governance where the sort of public was removed from economic management. And so to make a complicated story overly simple, Jackson effectively created a bifurcated money and payment system in the United States. So he famously vetoed the recharter of the Second Bank of the United States, ending an era of a quasi-sovereign banknote currency and a nationally integrated payment system. And in its place, the federal government, through the Specie Circular and the later Independent Treasury Act, was effectively confined to sovereign money. It could only use gold and silver coin, and it managed a kind of governmental payment system that was separate from private payments. Meanwhile, state-chartered private banks provided the emphatically not sovereign banknote currency for private trade. And during this time, payments also tended to operate through private bank networks, through bank drafts for long-distance trade, and slowly through bank checks, Dan's favorite financial instrument, for within-city transactions. And we can see again a kind of story, a version of this story here. Now, the Jacksonian division of sort of public and private money did not really work when it came time to wage civil war. And so on the money side, the Union balanced a spectrum of sovereign and non-sovereign money. So we have greenbacks, which are backed only by the full faith and credit of the US government. We have national banknotes, which are a quasi-sovereign money, which are backed by US government bonds. And then we have bank deposits in both state-chartered and nationally chartered banks, which are effectively private money. On the payment side, the Civil War marks several major changes in the payment system that increased the sovereignty of payments. So greenbacks became a standardized interbank clearing media, which replaced private banknotes. The National Banking Act created several institutional mechanisms, particularly rules for note redemption and reserve pyramiding, that sought to ensure that national banknotes circulated at par. And the Union States also turned the post office into a sort of public payments network, creating an inexpensive system for remitting small payments across the country. So again, we can see all of these changes here. And so finally then, to think about this cycle in full, we can reflect on the post-Civil War erosion of monetary and payment sovereignty. So on the money side, despite sustained political mobilization to expand the supply of sovereign greenbacks, the US adopted, maybe we'll call it a super sovereign gold standard in 1873. At the same time, private uninsured bank deposits made up an ever larger proportion of the national money supply. On the payment side, the key here is the rise of private clearinghouses to process checks drawn on these expanding deposit accounts. So clearinghouses existed in major US cities before the Civil War, most notably New York. But they grew, I think, with some government encouragement, so that there were more than 200 city clearinghouses by 1915, including in such commercial hubs as North Yakima, Washington, and Guthrie, Oklahoma. Why does Guthrie, Oklahoma need a clearinghouse? I don't know the answer. But the power of the clearinghouses over interbank payment systems points to some of the theoretical concerns that we hope to develop in the paper. And so in essence, we worry that private payment networks can pose systemic dangers in times of stress. And so two channels that we want to focus on, it'll be interesting to think about how our concepts overlap, and are control. That is, payment networks can choose who can access payments, especially during times of stress, and who is essentially cut off from vital resources. And the second issue is size, right? So we can say that private networks can become too big to fail, and may ultimately be bailed out with public resources, or to prevent catastrophic harm to the economy. And so we can kind of see how these issues worked in the 19th century banking panics. So in 1873, the New York Clearinghouse famously pooled the reserves of its member banks and continued to remit payments to country banks throughout the crisis. But in subsequent panics, the clearinghouse banks effectively shut off flows of payments to the rural banks, a practice that led to suspension and failure in the countryside when banks could not meet local demands for cash. And so, right, in some sense, private payments made these payment systems more efficient and more effective during normal times, but they could not be trusted in a crisis. And so, of course, the next moment of major monetary reform, the founding of the Federal Reserve, also contained fundamental payments reform as well, making payments sovereign once again. So finally, Jeff and I plan to pitch this, I think, to law journals, and that means we need some kind of normative, gesture. And so I think what we're initially thinking about is thinking about stablecoins, thinking about the kind of digital infrastructure, especially as we get both kind of fully private virtual assets and the potential for intermediated central bank digital currencies. That kind of offers a space to think about this public and private issue. But there may be more interesting spaces. Dan, in a conversation I had earlier, basically said if he could never talk about stablecoins again, he'd be happy. And I think that the implications of this story may be more interesting in other aspects of the payment system. I'm certainly excited to hear your thoughts about that. So, yeah, thanks so much.
Thank you. And now we have our final presenter, and that is Aaron Klein. Aaron Klein is from the Brookings Institution. He's a fellow and policy director of the Center on Regulation and Markets. He was a chief economist of the Senate Committee for Banking in 2008, and then he moved to Treasury, so he was someone right in the middle of the crisis. And he's written a guide to understanding fintech and banking law, as well as many articles on financial regulation. And so,
thank you. Thank you very much for having me, and thank all of you for staying around. It's an honor and a privilege to be here, and who doesn't want to be third on the Saturday afternoon payments panel. I will say, though, that one of the earlier bills I worked on the Senate Banking Committee was Check 21. And so I am really excited to geek out on Check 21 issues and the Expedited Funds Availability Act. But here, this paper is a paper I've given a couple times, including a version at the Nomura Foundation Macroeconomic Conference. I thank them for their support. The American Economic Association Conference in New Orleans, and is a version of which I hope to be coming out shortly, slightly modified with a co-author, Larry Wall, through the Atlanta Federal Reserve. I want to start because the premise of the conversation and the talk is fundamentally that this payment system has been a discovered tool for policy. And payments are becoming a new front in the war, and I mean that quite literally, as the paper will go into, for policy objectives. And we have not thought through the consequences of that. It is kind of like a group of people came and discovered this policy tool called the financial system, the payment network that they could use, and they started pressing it and pressing it and pressing it in a variety of concepts. And we don't fully understand it because they don't fully understand what those consequences are in payments. And people in the world of payments continue to maximize along dimensions similar to Dan's trilemma without thinking about the reality they're actually building a network to be used for other policy purposes. Before I go into all of that with great detail, I want to start with some fundamental definitional things. And I figured this conference, what better way to start than the meaning of money? This comes from Felix Martin's Money and Unauthorized Biography, which is super awesome. And it's really important that we drill down. Money is a system of debits and credits with third-party acceptance without prior party consent. It is not a medium of exchange. Anything in the world here can be a medium of exchange. Dan and I went out for lunch. Dan didn't have his wallet. I paid for lunch. Dan owes me a lunch. That's an asset on my balance sheet. Paying for lunches with friends is a medium of exchange. It is not money. Why? If I happen to owe Sean a lunch, I can't say, Sean, I owe you a lunch, Dan owes me a lunch, you guys square up. Right? We've all had a friend try to do that to us. It doesn't work. That's a distinction between an asset and money. And if you think of what money is, this definition, right, then means that you can't have money without a payment system. If it requires a system of debits and credits, the payment system is a prerequisite for money. And this makes it a much, much more powerful point. Now, the paper goes into some more detail about the history, barter. Milton Friedman has a really good paper. It's a strange thing to say at a conference that's pretty far to the left, but it is really good on this stone currency used by a tribe in Micronesia. Most money is electronic, right? And so we move money digitally. We have a digital electronic system. This system is highly centralized for reasons of networking, and that creates a very powerful engine. So, one other point just to make on core the payment system, people think of payment system as a transaction of money. It is two parts. It is one part money, the actual settlement of funds, and the other part information. Who, how, when, where, why. The flow of funds is totally separable from the flow of information, and I would argue is the less important of the two flows, right? If I Venmo you money, there is no flow of funds. If you get a check from your great aunt for your daughter's bat mitzvah, hypothetically, and they happen to be at the same bank that your daughter's bank, there is no flow. There's just a change of a credit, right? Nobody's taking money out of this person's account and putting the money in that. You're just changing the ledger. Now, there are times where you have to settle up. Often those settle-ups are done on a netted basis, not on a flow of funds basis. With real-time payments, that changes a little bit, but not necessarily. But the flow of information is what's key. From whom, to whom, how much, and when. When we think of payment systems, right, like we think of SWIFT, SWIFT is just information. There's no money that goes along in the SWIFT system. It's a messaging system, it's a data, it's an information system. So, why do we have these systems? Well, the economist in me says that we have payment systems to maximize economic growth and activity and trade-off, right? That's the whole point. We should build a payment system that facilitates the goods of trades and commerce and everything as efficiently as possible. A different part of me says that though he or she who has the payment system, right, to paraphrase Newman from Seinfeld, right, if you control the mail, you control the information. If you control the information in a payment system, you can exert a lot of power. And so these are the core two tensions, the paper points, that the payment system people think the entire purpose of the payment system is the stuff about maximizing the economy. And politicians have realized, wait a second, no, I can do this to maximize a series of other political objectives. And I use the term politician not pejoratively. I use it positively, right? So let's take something that I think would have unanimous support here, human trafficking and slavery. No one's for that, right? We use the payment system to stop that. We try to find the flow because most crime involves some level of money. Most people are trafficked, right, for a financial purpose, and you can use that system to stop that. That imposes some sort of cost on the maximization of trade, right? There is a trade for these types of services. It's disgusting and repugnant, but it exists. It's criminal in nature. And we use the payment system in various ways for this. And what I'm going to point out is what is starting out here is a set of political choices. Some, I think, would have as much support as what I talked about, human trafficking and slavery, others far less. And that is continuing to grow. So I think this group doesn't really need a full explanation, but as you guys know, we have our existing payment system. Then we have alternative payment systems that are not US. The point of this slide is to highlight the US as a unique dominant role in global payment system, both because of our role in the dollar and trade, and because of our role in the macro economy. And there are alternatives. Crypto, China's built a system, etc. So whereas while we have the current control, it doesn't have to be like that. Okay? Here's an example to show the growth of one alternative. Like any crypto slide, if you're not updating it weekly, it kind of feels like it gets out of date, but it just shows you that these systems can grow super fast. Now, herein lies a point, right? We can control our dollars for foreign policy. A lot of paper talks about the foreign policy, right? You know, Iran was on the SWIFT system until 2012. North Korea joined SWIFT in 2001. North Korea is a nation America is at war with. The Korea War didn't end. There's just a pause. Right? People forget that actual fact. We have allowed this system to be one to have both enemies and adversaries, or at least we had. Now we are starting Cuba, right? Other things. We are starting to do this. At one point, and so the question then becomes, right, as people want to have tougher sanctions, so financial sanctions are actually the purview of the Senate Banking Committee. You'd think it would be foreign relations or something like that, but sanctions want to be tougher. Well, eventually, how do you get tougher? You start talking about access to the payment system as this new tool so that your new bill can be tougher than your old bill. And we've seen this, right? The most blatantly, we saw this with what happened when Russia invaded the sovereign nation of Ukraine for the second time. The first time Russia invades the sovereign nation of Crimea, there's a lot of anger, etc., but they're not kicked off of SWIFT. The second time Russia invades the rest of the sovereign nation of Ukraine, we respond not by sending troops, right? Not by immediately sending military supplies, although we eventually did that, but we kicked them off of SWIFT, stating, and I think rightfully so, and by the way, this part of my presentation I think is why Russia has banned me. I'm on the list of banned Americans. Proudly, I have no problem getting kicked off of their network, and I have no problem kicking them off of our network because I believe you can continue to have this global system and set rules of the road. Like, if you invade a sovereign nation, you're out. Don't invade a sovereign nation, you stay in. I don't think that's going to move people to the Chinese payment system, right? Now, not properly following simple rules like that may. Why was the second invasion of the sovereignty of Ukraine triggered this response, but not the first? Hold that aside. A point here that I want to point is politicians take positive and negative feedback loops. And what we have found here is support for the politicization of the payment system as a tool in this structure, far greater than we would, for example, to send American troops into the battlefield. So I've talked a lot about different ways that we've turned the payment system up in foreign policy, Cuba, kicking Iran off at various points, now Russia. I want to take for a moment and talk about it domestically. And this is the kind of hidden gem buried inside the paper, but I think needs a little more explanation, which is in the mid-2000s, those of you who here remembers when online poker became a thing, right? It kind of like blew up out of nowhere, right? And then it went away. And it went away because Congress passed this law, and the law was kind of a watershed moment because the elimination of online poker was done through the payment system. It required Visa and MasterCard in their networks and issuing banks not to upload or process payments up or down to poker sites. So you had to find poker stars, you had to find all the registered poker people, and basically boot them as a merchant. Now think about that. We don't do that with any other illicit activity on the payment system. If you, I can talk about it as it relates to, for example, pornography, which has been a growing case for those of you who read the New York Times and Nick Kristof, Backpages, OnlyFans, right? Places that traffic in the thin line between pornography, voluntary sexual services, and human trafficking in involuntary sexual services. Previously, the rule of the payment system for those folks and everyone else was if you saw illegal activity, you reported it. See something, say something. Suspicious activity report. But it didn't require you to get kicked off the system. In fact, to the contrary, the idea was the way to catch the criminal is to have them in the system and then use the system to find them. But here we see, in the latter cases, the payment companies more voluntarily kicking off providers, in part due to public pressure and in part due to litigatory pressure. Victims of these crimes were then suing the payment arms, most for kind of two reasons. One, they believe that payment facilitated the crime that then led to their situation. And two, that's where the money is, right? It's very hard to sue the pimp who trafficked you, but right, how much money is there? But if you go after Visa or you go after JP Morgan Chase, right? You just saw JP Morgan Chase, I think, just settled $290 million in the Epstein case. Another, right, that's a little different, but not completely. Right. Third, cannabis. We have a completely schizophrenic, illogical position on cannabis, although I point out gaming as well. That law, the online poker law, passed in 2005 by 90-something votes in the Senate. Subsequent to that, the Supreme Court has basically legalized gambling in any state that wants to do it, overturning prior laws. Gambling is rife on your phone. In this state, Massachusetts, I think you can bet on just about anything except play a hand of cards with a friend of yours in another state, because the congressional law bans that. Similarly, cannabis, right? You walk around Harvard Square, there are all these dispensaries selling state-licensed, state-produced cannabis, and a set of network requirements, right? And a schizophrenic Federal Reserve. The Boston Federal Reserve allows banks in this area to process cannabis payments through them, but the Kansas City Fed doesn't. In fact, a credit union that was charged to try to do this was famously denied a Federal Reserve master account, right? Again, and abortion and guns for those who have similar situation, Visa, payment processing, right? So this payments tool is becoming more and more prevalent, both domestically and internationally. And I think it's going to continue. I think it's going to continue because it's an effective tool for people to get a policy outcome they want. It doesn't seem to have that many impacts negatively yet. Does anybody here stop using Visa and MasterCard because they won't access your payment system? They won't upload your poker account. Some people do some complicated workarounds, right? There's a bunch of cannabis workarounds or some other things. You've seen political blowback, particularly on the merchant codes for guns from Visa and other things. But it still is an effective system. And on the foreign policy, the sanctions and other aspects, it is not just successful, it's also politically popular. Now, there are potential tipping points. The world of payments show that these are large networks and they work until they don't. And there can be a small marginal change that finally tips the balance point and moves people into a different system. And should that happen, the consequences would be very large. Should something happen where a bunch of people decide to go to the Chinese payment system, decide to settle in euros for a very different reason? The Europeans were quite upset with some of the Iran sanctions and some of the payment requirements there, particularly European companies that had long relationships with Iran. Siemens has a contract to run the Iranian subway cars in Tehran, and they were having problems, being threatened with lack of access to the US payment system, things like that. And then there's also crypto hanging out there. Why do you even need countries to do this at all? And this is often a test case and use case for crypto. We can debate that. Part of the reason if I could leave you right with one thought on crypto, is that all other money is state-backed, and whether or not crypto works as non-state-backed money, and then what does that mean for a global payment system that can be denominated in things not controlled by any collection, nation, individual, or collection, and if the U.S. doesn't have a CBDC. Those are kind of the final thoughts I have, and I'm really excited to do Q&A with my fellow panelists. Thank you.
Your slides now? Yeah. Yeah, so I mean, I have just some thoughts I had on reading the papers, and broad, I think, a little bit about payment systems, and all right, let's see.
Right now.
Okay, yeah, so that's just a summary of the papers. I don't think I really need to go through. Everybody was really clear. We all know different things. I will say that Raül Carrillo had a nice paper on the privacy costs of the digital dollar. So anybody who's really interested in studying like what to do about privacy issues in digital money, it would have been great if he could have been here. Okay, where do I need to point this?
No, you just hit it over.
Right.
I think you're hitting the wrong button. It's okay, you can use the keyboard.
Is it keyboard? Is it enter?
No, just go right
down.
arrow.
Ah.
Try the right. Okay. Oh, there you go.
Down? Okay. Okay, so I have to. So one of the things, as I'm reading this, I'm really feeling that there's a lack of distinction between like what do people mean when they say the payment system, and how are you distinguishing it from the monetary system? And it's part because when I look at banks, to me the whole point of a banking system is to integrate both of these. So. Yeah, and it's not something that's really tackled, for example, in Awrey's work, but when I look at your work, Aaron, and your claim that payments are the prerequisite for money, I mean, the first thing that jumps out to me is, well, wait a minute, that's almost the exact opposite, right, of your argument coming out of Ingham and Orleans, and it's basically heterodox concept that actually you need a stable measure of value before you can even move on to anything, right? And that basically you need the money in the sense of a measure of value before you can get to payments, to exchange, to any of these things we're talking about. So I do want to push back against, some ways of framing this idea that it's really simple to say, payments have to come first and then money. I think basically, it's one of those things that, like Carolyn at the store might say, it's topological. It's a really complex chicken egg kind of problem, and I think we want to be really careful about not simplifying it when we discuss it, basically, and thinking about this complexity. Wrong way. Okay. I think also in the Vanatta and John paper, I think this trying to draw this really clear distinction between private money creation and private payments, and then saying, well, we understand about the dangers in private money creation, but we haven't really appreciated the same risks in private payments. I'm not really following how clear this distinction is. I think I need, in other words, I think frequently when we discuss these things, we're actually thinking of them as very closely related, and so closely related that monetary instability is really also payments instability. We're talking about monetary instability, we're talking about the banking system, or we do middle payments. So I have some doubts about some of that framing. Sorry. And I want to think, just bringing in some of the background that I'm familiar with, if you look historically and the legal infrastructure of our monetary system, it's basically payments law innovations that provide the certainty and the irreversibility to have a monetary instrument. So if you look at 1700s England, bills of exchange were initially viewed as contracts, right? It's when you get this switch to the invention of payments law, and you get certainty for the bill as something that has to be paid under the law, that's the point at which you start to really get a monetary aspect to it, which is very much something that you know, England kind of is famous for having kind of monetized, gotten the strongest monetary use out of the bills, even though they've been in existence for a very long time. And I think similarly, we can think about, even as our financial system evolves, wire transfer law, it's, you know, you get that law, it creates incredible certainty. You know, when you call up your bank to do that wire transfer, to do the house deposit, you will notice the bank is like, okay, you have given me these instructions. Let me go over them with you again. Are you entirely sure that you want to do this transaction? Why do they do that? Because if you've made a mistake, it's actually one of the least reversible things you can do, right? So, you know, if you write a check and it's a mistake, there are a lot of ways out of it. If you have a mistake in your wire transfer, like there have some really the certainty in that transfer means that you don't have the same amount of dates you would typically expect in other things. And that's some of what makes it work is money. So I think that, you know, this, what is payments and what is money, I think they're really closely interrelated. And so I want to push back on some of the distinctions that are being drawn. And I mean, I do think that you have a really clear distinction when we think about bank-based payments versus non-bank payments. That's where we start to say, oh, okay, maybe we want to draw a line here. But I think this term of payment system and monetary system, we need to be really, really careful how we use it. So now this also is really coming out of the Vanatta work, where you're talking about why are money and payments combined in banking, and I just want to go through really quickly, like, this argument that I try to frame. It's actually coming from an economic theory argument that's a little complicated, but the old understanding of what banks do is that they take a non-monetary IOU, and by putting their guarantee on it, they convert that debt into a monetary IOU. And so the key thing that banks do is that they're considered safe, and so once they've intervened, you've changed a standard IOU into a monetary IOU, and it's really the sense that lending, the lending aspect of banking and the payments aspect of banking are absolutely interrelated, right? And that comes out of thinking of banking as a bills of exchange type system. And so then if we want to think about the economic value of banks, it's really that their liabilities are money, so they're able to fund drawing on the general public's acceptance of money. So they have this vast ability to fund, and it means that their issuance is constrained only by the need for them to issue good loans. They need to have good issuance standards, but this can support really cheap lending, basically. So there's a really economic engine aspect to banking, which is why these things are integrated. And so I encourage people to kind of think of this as something that's very natural to put together, even though a lot of the literature likes to think of it as separable. And I think the best way to think about it is, like, imagine if you've got a credit card system that's universally available with small credit limits to startup firms. It extends additional credit carefully and regulated firms with good payment histories and charges 7% or less per annum. You're talking about the initial banking system. That's what it's doing. And there's a reason why banking, money, and payments are together. It's because you can fund this credit by drawing on people's acceptance of money, right? And that this has a huge economic role, basically, that you can think of as part of circular flow payments. So I want to encourage at least some thinking about, like, why it might be natural to put these two things together, right? And then, all right, so then the other thing that jumped out more from your paper, Dan, is competition. And I have to, it's always jarring to me as an economist to see how the framing in the legal literature does it, because there's a tendency to talk about competition as something that's a pure good and this is what competition gives you. And especially when I think about financial institutions, we have to keep on dancing, right? Competition, especially in finance, has some well understood, bad aspects. It can be pathological, basically, where you have this situation where the bank that wins market share, the bank that underestimates its risk is the one that wins market share. Everybody looks at it and says, oh, I'm supposed to copy that because they've got their market share growing, and you need a system that keeps it. So competition itself can be very pathological and has a history of being pathological in banking. So I guess I would just be really careful about some of the framing of some of that. So those are the things that kind of jumped out to me as comments there, and I think we will open it up to everybody else's questions.
Can we respond to that?
Yeah.
Do we want to do microphones?
Yes, definitely for the other. So we want to use this? Yeah, you.
Oh, got that, yeah.
Although you're not. Although I think it is nice if you're at the lighter side.
Sure. So thank you. I just wanted to clarify a couple of things. Remember, I only went through one of the three parts of the trilemma, right? And part two is the stability competition trade-off, which is crypto, right? You have unfettered access, a whole bunch of wackadoodle investment throws in the short term, but in the absence of any sort of mechanisms designed to enhance stability, you end up with a system where over the long term, at least some of this stuff is going to fail. And insofar as it's interconnected as a network, we know full well from conventional finance how those networks can become the channel for the loss of credibility throughout the system. So I completely agree. So I just want to clarify, we only looked at the American system. Competition is not an unalloyed good, but in terms of consumer welfare, the absence of competition, I think, has had material impacts. People are poorer because of slow payments and overdraft fees. Businesses are less dynamic because they're paying, and I'll do this just for you, because they're paying hella high merchant fees to credit card companies that are a huge proportion of small business margins. Like, competition is not an unalloyed good, but the failure to harness competition within a public law and policy framework designed to minimize those things, I think there's a lot of room for creative public policy making there. And I had to say that money versus payments thing. I spent a lot of time on this in my book. A lot of the theory that we discuss, especially you guys as historians, when I think back to somebody like Gresham, money and payments were the same thing. Gresham's law works because it's all about the patterns of how people make payments and how they choose between which money to use and what not to use. In physical currency, the two become one. And I think Aaron's comments were very in line with the way that I think about this. As we digitize the payment system, it starts to become much easier to separate the claim, money, from the legal, institutional, and technological processes by which that claim is transferred, which is payments. And that, I think, opens up a lot of space, not discussed in this paper, but in general and ad nauseum in my forthcoming book, Princeton University Press, 2024, to be able to actually look at these as fundamentally different problems. A credibility of my monetary IOU problem versus a building stuff on the interwebs problem that focuses on things like network design, cybersecurity, moving things fast, moving things conveniently, that are more infrastructural in nature and different than the claim itself. But thanks very much.
Yeah, I mean, I'd just like to kind of pick up on that. I sort of see this, and I don't know how much it'll get developed in this paper, but as both the kind of intersection between sort of legal constitution of money, which seem to be the kind of core of your comments, and then, yeah, the kind of like physical infrastructure. So if I am a Nebraska bank and I call or telegraph my New York correspondent in 1884 and say, listen, we need a lot of gold because people are withdrawing from us and we need the physical money to pay it out. The payment system is like putting that gold on a train. and then like shipping it across the country. And that, and then there are these moments like, yes, we'll send you the money, but like it's going to take some time, and that time is really important. And so even though there are legal obligations that mean that it maybe will happen with time, how it gets there really matters. And so it's trying to kind of think through this overlap between what makes up the network, whether it's, again, a rail network that's the payment system, or digital networks, and who has control of that process. Yeah, I think that's enough for that. Questions? I'm not in charge, but you're on.
You're in charge.
I'm in charge.
No, I'm gonna the question, not the charge. Yeah, do we want to do like a Q&A or?
Yeah, what do we do? Let's do 4 questions, and yes, why don't we do these 4 questions, and then we'll do the
You're in charge.
First, thank you so much for the amazing presentations, and I do have one question for Dan and then one question for Aaron. So you were talking about the float and also like the fact that banks are delaying like these final settlements, and I wonder what's your view of like the system that is moving towards this real-time gross settlement that increases the need for liquidity and therefore provides incentive for, or increases the incentive for the bank to actually delay these settlements even further. And that's the question that I have for you, and also like if you could comment on something which is related to that, which is the different designs of this liquidity saving mechanism, which is being introduced along this real-time gross settlement in order to actually tackle the same problem. And if you have any view on how to design this mechanism. And the question that I have for Aaron is that, first of all, again, I really like all your presentations, and I really like the way you frame the payment system as this is the flow of information because of the clearing aspect as along with the flow of funds or money. I want to say, I also think that there's another flow, which is the flow of risk, because especially for the corporate treasurers, in order to make those wholesale and sometimes cross-country payments, they also need to manage so many payment-related risks. So it also really, their ability to make payment also really depends on their ability to manage those risks properly. So I was also wondering if you think adding risk and risk management as a pillar of payment is the right way to think about this mechanism or not.
So, do I need this, or this is a fairly small room? Does this help?
Yeah,
All right, so I have I guess a comment or a question or some kind of suggestion to Sean, because I take it at face value the fact that you guys are just starting this paper, and so when I read the title of the paper, I got really excited because
Welcome to my world.
Thank you. I got excited because this whole notion of the tension and the overlap between the public side and the private side of the financial system is precisely what I find and long found very interesting. But a couple of things. One was that my expectation was that you would actually, using your tremendous expertise in history and Jeff's knowledge of the mechanics of a lot of these infrastructures underlying modern payments and money, would hit this with this paper at precisely the interesting question: why is it that even though money creation itself is clearly hybrid, public-private, and the public side of it is what makes money more money-like than less money-like, in that system we nevertheless persistently choose the infrastructure being privately run? And that why question, in your write-up, you say in part 2, this is what we're trying to answer, right? But I don't see that answer anywhere, or even a hint at that answer. In other words, I would be expecting things like, maybe there are some operational or administrative, synergies or gains being, had from kind of shifting this kind of resource-intensive work down to private actors. Maybe it's a political issue, maybe it's a matter of governance, right? Or mistrust to politicians or to the government running the actual rails, as opposed to creating the thing that moves on those rails, whatnot. But none of it I see here, right? So, and one thing that I particularly kind of bristled against was the term sovereignness. I'm not sure it actually adds anything analytically or gives us any kind of normative hook that we haven't had before. In some sense, what you're trying to talk about when you're talking about this thing, somewhat in parallel to the moneyness, right? But what you're talking about here is what Anna Gelpern and Eric Girding have written about already some years ago, when they talked about manufacturing, legal and institutional manufacturing of safe assets. So that's sort of, that's the gradation, right? That's the spectrum between the assets that are made to look safer and assets that are not made to look safer by the government. So, of course, you may think that who cares, right? We like the word and that's fine. But if you do that, then perhaps you should at least incorporate that literature. But I'm really excited to see the paper when it is finished, and I'm really hoping that you really answer that question, why? And what does it matter? Is it good, is it bad?
Hi, my name is Kiko. I'm an independent researcher, and I'm one of a few co-organizers at the Young Scholars Initiative that are building a community just focusing research on financial market infrastructure. I just want to get that plugged in. I have one question, and that is does any of you panelists have a view how to think about the M-Bridge project, which was done by the BIS hub in Hong Kong, where they did a payment system focused on CBDC. I don't know if any of you had any thoughts on that. Thanks.
Thanks. So this is a super rich panel, and I want to say a little bit of something to each of the panelists. I'm very much in the spirit of what Carolyn was saying. So payments are hierarchical. And there's a few reasons why payments as in payment systems are hierarchical or naturally oligopolistic or indeed monopolistic. One, network effects. Two, the monopolistic nature of the settlement instrument itself in the money, right? There's only a few things, or indeed one thing that will count as money. So that makes it. And the other thing is that, and I really want to sort of dwell on this, is that the payment system is a credit system. But it doesn't always appear like one. So we think of it, this is, sort of connects with my the little paper I gave here, which is about fetishism, which is that we can think of the payment system as a kind of logistics system, as a kind of moving money stuff around, perhaps even in real time. But we can only think about that when it's, as it were, fully fetishized, when the settled instrument is fully stabilized. So I kind of do agree with both Carolyn and with Dan and Sean that it is separable, because at a certain point of development in the system, it stabilizes enough that we can just think about it as a kind of logistic system. But this separability is itself kind of endogenous, and it's endogenous to the credit cycle. And I'll come back to that when I talk more specifically about Sean's piece. The one kind of really nice piece of evidence and that was mentioned in terms of the RTGS, to think about the payment system as a credit system as opposed to a logistics system, is think about the RTGS system is the most logistics-like piece of the credit system, right? This is real-time money going, like actual stuff, and this is not actual money, of course, but money is a ledger entry. So when you make a ledger entry here, that is the flow. The flow is just a physicalist leftover of, right, that's the money flowing around. RTGS systems have intraday credit, right? So the most real-timey, logistically, between banks, right? This is not even, these people can create and destroy the damn thing, right? But their settlement instrument is outside them, it's set to run money. That they can't create and destroy. Banks need intraday credit. So in other words, you can't do payments without banking. In other words, the creation and destruction of the settlement instrument. Now, the settlement instrument is outside banks, it's central bank money. So of course, it's the central bank expanding and contracting its balance sheet intraday so that the web of payments doesn't snap, right? So that for me is a really nice kind of proof, if you like, of what Cal was saying, is that is the settlement instrument, it's not a, or if you want to think about it, it's a logistics operation where you have this one operator who can magic up the packages and then disappear them away. So it functions a lot of the time, most of the time, like a logistics system, but at certain bits of the system, because at that bit of the system, you have to kind of create and destroy it. And that's, so the ledger piece of it is kind of important, right? It's not, when you say there's no money, there's no flow, that the ledger entry is the money, right? Because it's most of the money is just ledger entry. So Dan, and then Sean. Dan, the hierarchy is true of many utility businesses, right? That's not particular to money. I mean, a lot of infrastructure, electricity, transport, rail networks, etc., communication, these are all naturally monopolistic or oligopolistic kind of systems. They could, in principle, be private, but then bad things happen. But what is the ownership status of it? There will only be a few operators, right? Neoliberals cannot manufacture competitiveness in these things. Or if they do it, I mean, look at what the British have done to their rail network. It's a mess, right? So you can't. That's what happens when you try and force competition onto a naturally monopolistic or oligopolistic situation. Therefore, and also by the way, hierarchy is why it's a super effective policy tool, because you can it's naturally hierarchical, and it hits a lot of people. So the bottom line, it seems to me, is that you just have to regulate it like you regulate utilities. You have to just make sure whatever rents these guys keep extracting is just legislated away. I don't think inducing competition is going to do it. And is that a political problem? Absolutely, that's a political problem. But and I'll just say one more thing. I completely agree with your hostility to technological determinism, and I think that's absolutely right. But I think when I think of access coming from an Indian standpoint, it's also about user access, right? How many people can actually, not just business access to the infrastructure, but user access. And what we've done is that by getting a lot of users, admittedly it's not massively inclusive because it's still people with a bank account and the ability to buy a smartphone and so on, and do the equivalent of kind of online checks. What we control the liquidity now. So we tell the banks what to do with the liquidity, and they have to kind of respond to that. So a change in tech can kind of potentially tip the scales one way or the other, even though it's not deterministic. It can shake things up and change the balance. So Sean, you see these cycles because credit is cyclical, right? Payments is about acceptance. What instrument will you accept to liquidate the debt? It's not a means of exchange. It is a settlement of a debt, right? And so whatever legal tender is, that's just one piece of it, because acceptance is a market outcome, right? And in a kind of boom time, we accept a lot of stuff in payments, because the distinction between credit instruments, that's the definition of a boom, between good money and bad money kind of goes away. The hierarchy kind of flattens out. What's at the bottom of the hierarchy changes over time. In one era, it's crypto. In another era, it's wildcat banking, or whatever. Right? The Ponzi instrument, if you like, can change over time. But what is happening is that there's a credit cycle, and these kind of repeat. And when the cycle turns, no one wants credit. Everyone wants money, right? And so that you can kind of, and then the hierarchy steepens, or the politics intervenes, and then crappy stuff is backstopped. I mean, we heard about shadow banking being backstopped yesterday when it could have gone away, and that's an economic judgment, that's a political decision, etc., etc. So the cycle doesn't kind of clear out fully. My biggest fear was that crypto would be regulated, because then it won't go away. But anyway, yeah.
And we do have one online question. Do we want to?
Well, let's
let's let Aaron hasn't a chance to reply, so let's
Yes,
let Aaron
so
reply.
let me reply, and rather than I'll do it the opposite of the way I handle my email. I'll do the queue and not the stack. So turn to the first person who asked the question about how to think about risk in payment. So there's absolutely a series of risks in payment. I don't think it's, how should I say this? I don't think it's an endemic quality that rises to the definitional point of that payment is both a flow of information and a flow of money. I think risk is a set of attributes. Payment systems have differing levels of risk. As a result of that risk, people may choose different payment systems. If you, there's a really good paper that I've not yet seen written, taking a look at the Electronic Funds Transfer Act as a Coasian solution to the question of fraud risk as it relates to the adoption of debit cards, in which people, which the government needed to assign the property right or the liability, and then the market was able to transfer the risk. So I think that payment systems, depending on their construct, can have higher or lower levels of risk. I'll take just my soapbox for a quick second, like fraud. Everyone uses fraud as an explanation for why they don't serve certain people, and 98% of the time, in my opinion, that's just a load of crap. If you are really concerned about fraud, you have to enter your zip code. You can do a two-factor authentication for debit card transfers or credit card. It's called putting in your zip code in American context. Only place you ever see that is in gas stations. Why? There's a huge amount of fraud at gas stations on stolen cars. And two, gas is a loss-leading transaction for the convenience store is the goal. If fraud were really important in every other context, you'd be putting in your zip code when you make these transactions, right? But what's more important to them is moving the line, and they deal with the fraud risk later. So I don't think it, I think it's an important factor, and I think how you mitigate or manage that risk across the spectrum can make those changes. Kiko, you asked a question about the CBDC. CBDC is, you mean central bank digital currency?
Yes.
We all have CBDC. America runs on CBDC, commercial bank digital currency. Swapping the first C from commercial to central is the core question. I think if you take the position that you need to regulate it like a utility, then that might have some appeal. If you take it as a position that every utility I have as a consumer absolutely sucks, and every payment utility the Federal Reserve has operated, somewhat kind of where I think Dan's paper is headed, has been to maximize economic value for banks with zero interest on consumer well-being, then I kind of would rather, I'm not here to praise commercial bank digital currency, but I'm here to say that there's a competitive market for it. It operates in ways that have some problems. I don't think the Federal Reserve as a central bank would do it better. In fact, I fear they'd do it much worse. So I haven't taken a look at it, in part because I'm kind of, from a retail perspective, wholesale is different. But again, with wholesale, I have a different set of critiques. Take a look at the Fed's 27 primary dealers and ask yourself, how would that look on a DEI basis? The final point, you said you used the term credit, and you used it twice. So I went and looked at the definition of credit, and it's a homonym, right? The first definition is the ability of a customer to obtain goods or services before payment based on the trust that payment will be made in the future. I think that's what you meant it as. However, the second definition of credit is an entry recording a sum received listed on the right-hand side of a column of an account. When you said the payment system is a credit system, I didn't know if you meant the first definition of credit or the second.
There's an intention because you can make payments with credit.
You can make payments.
As in money is a this is a longer conversation.
Right. So my point there, I do believe you can have payment systems without banking. China did it. Ali and WeChat took the entire payment system away from the banking system.
But there was still Ali IOUs functioning as money. They're not. It's someone's IOU functioning as money. It's not bank IOUs.
Correct. So you don't need the bank.
No, but you do need IOUs.
Correct.
So any IOU that functions as payment is money. M-Pesa is Vodafone IOUs working as money. So M-Pesa is a
right. So the only disagreement I have with, well, it's not a bank.
I mean, functionally, not.
No, it's not functionally a bank. Any retail store is not a bank. A bank takes deposits and makes loans. If you're not taking deposits and making loans in the US context, it's not a bank.
It's a bank in the context that its liabilities function as money. In that sense, it's a bank.
Again, my lunch with Dan doesn't function as money. It's a liability of an asset.
I highly recommend my term for this, which is monetary IOU, as the way to think about it. I'll go in reverse order and be super quick. And I think there may be some misconception. I think competition is the problem, lack of competition is the problem, but not the solution, right? The solution is to pivot to say that actually where private investment fails, public investment should step in. The reason why I wouldn't do it utility style, and that is my logic, and if you know Josh Macy, you know that that is like the burning desire in his soul is to treat this utility-like, is that doesn't help consumers in this particular case, because all you're doing is skimming off the money, the rents, the economic rents, but then consumers still have a crappy payment system. Sure. And that's that, and you and I think would be on the same page then as soon as you routed that back into the investment. So I think we are exactly on the same page on that front. Kiko, I'm on the exact same page as Aaron here as a lifetime long designer of payment systems. Every time somebody comes up with a CBDC project and they say, look, it works in the lab, I just pat them on the back and I'm kind of like, I've got Swift in an Excel spreadsheet. I can do this already. I just don't understand what the big deal is about it. I've got to have clearing interoperability, which is just the ability to have a system of communicating in a format that we all understand and can process. And I've got settlement interoperability, which is just my ledger. That's easy. We've been doing it forever. And I feel the CBDC people have like gnat flies or something like that, where they just can't recall that actually we've been working on this stuff for a couple of centuries now. I don't get it. So I've stopped looking and I've stopped accepting offers to come consult on this stuff because I'm kind of like, I can do this, I can do it now, I don't understand the problem. Great question, we're super short on time. I am a big fan of hybrid RGTS systems that have liquidity sort of management tools, partially, and I think this is a trade-off we don't talk a lot about, is that because I have daylight overdrafts, I'm okay with all of this. What I'd like to see is that, for example, if my bank needs a daylight overdraft, I don't want the customer to feel a thing. There doesn't need to be a delay in the customer's account being credited because within the payment system with daylight overdrafts, nobody's going down. No. There's no risk effectively left in this system.
They're just harvesting the flow.
They're just harvesting the flow. And that's where, and that goes back to the paper effectively, whereas I think saying that there's actual credit risk within this system and therefore we need to build latency into the payments is a bit hokum. But I do agree that on an individual bank level, having the hybrid in hybrid RTGS can be quite valuable for managing intraday liquidity. And so well designed, I think they're perfectly okay. But we do then need to understand that that's a benefit we give them, especially daylight overdrafts. And the cost should be then making sure that from the consumer's perspective, all of this is like a duck on the water and nobody sees what's happening underneath.
I just want to say thank you. I want to apologize to Sully for interrupting her, so I shouldn't have done that.
That's right.
And yeah, there is a lot that we still need to think about. That is the key question, why? We don't have an answer yet, but we're going to try.
I think we're going to have to wrap it up. So unfortunately, I'm sorry about people who, maybe those can come and talk to you guys individually. I don't know the other questions, but yeah, we're gonna have to wrap it up, and apologies to the person online as well. Thank you all.
Well, so I guess I have so many questions.